let's get started. Let's get started. I think this is where we left off, wasn't it, last week? I'm trying to keep track of the different units. My goal today is finish up all of this last section, including topic 10, and then to go ahead and do the review for the final exam. That way, next week, all you'll have to have is Russell's coverage of the rest of the unit. But I'll go ahead and do the review for this section. If you need to carry on conversations, I'd prefer you do it out of this room. It's very loud down here. Okay, so I wanted to finish up caps, floors, and collars today, and then topic 10 on credit derivatives. And then from there, I asked Axel, there was some people had some trouble with the exercise problems. I think they were, let's see which numbers they were. 9. I guess it was 9, 2, or I think it's probably 9, 4, and 9, or 9, 4, and 9, 7, I guess. 9, 7, and 9, 8. So I just want to spend a couple minutes on those because the point of those two questions had nothing to do with the maths. And so I thought the question was poorly asked for you to get the point. And so I want to just spend a second that it's not the maths there. You can go to the, if you want to see the maths, you can go to the solutions and get the maths that are involved. But I want to explain to you why they asked the question and what the information they want you to get from it. Because I thought in every question there should be another part to the question as, what does this tell you? And so I'm going to spend a couple minutes on it because it's very important concepts. Might take us a little longer today since I'm going to do the review, but just remember then next week, that's less to happen next week when Russell comes in to do the rest of the review for the final. Okay, so caps, floors, and collars. There are different types of, they're used with options, and if we're in the stock market, some of them would be stop losses, equivalent to putting a ceiling or a roof on something. We use this with interest rates so that we can set up a band or a top or a bottom to what will allow our interest rate to swing to. And so when you buy a cap, it sets an upper limit on interest rates. As it says, it puts a cap on. So if current rates are at 6.5% for a loan over 3 years, the cap buyer will pay a premium to ensure that he can fix that the Gentlemen, if you don't want to listen to the lecture, please go out in the lobby. If the cap buyer pays a premium to fix the maximum interest rate at 7%. So they just say, we'll let it vary, but I don't want it to go over 7. And that way they can plan. It's like buying insurance against an excessive increase in interest rates. It's a very important tool for corporations, especially if, in a sense, they're going to borrow money and it's got in the future, and they expect interest rates to go up. A lender will buy a floor because remember, buyers are going to borrow money, so they want to fix the top side. The lender wants to fix how low it goes because they make their money on how high it is. So a lender will buy a floor to fix a minimum borrowing rate. So they'll put a put option on interest rates. Now a collar, we'll go into these a little more in just a second, is where I put both on. It's done commonly in foreign currency options, and I think you probably discussed it in your FX section of the unit. So you buy a cop and you sell a floor option, and that will form a collar, and it just makes a narrow band. Caps, again, is a call option on the future realization of a given underlying LIBOR rate at a specified date in the future. Now, it's not always LIBOR. It can be any reference you want it to be, but the LIBOR is the most active and the most widely used. And it's used by institutions to limit risk exposure to upward movements in short-term floating debt rate. And speculators use it a lot to make volatility plays in uncertain interest rate environments. So it's used by both, but mainly by institutions. Interest rate is a series of sequentially maturing European-style call options. So normally it's not one option. It's a series of them. And so the cap payoff is the difference between you're giving up gain in some ways. You caps it at a certain place, and if with no cap, if the rate keeps going up, and you wanted interest rates to go up, then you're losing that gain. If you're a lender, you're losing with the cap. If you're a borrower, you're gaining because you're not paying that extra. The advantages of caps are buyer limits the potential loss to the premium paid, but retains the right to benefit from favorable rate movements. So the upper limit's placed on borrowing cost. So you're limiting how much you'll pay in interest, but if the interest rates go down, remember, an option is just the right to do something, not the obligation. So if interest rates go in favor of you, then you go ahead and take your loan out in the spot market. They're flexible. You can continually move them up. You can take the opposite position. They're quite easy to adjust your expectations. If your expectations change, it's very easy to change them through your hedging. You're not locked in again if you have a contingent event. Maybe something happens, and they're highly geared. What do I mean by geared? Leveraged, and leveraged means it takes a little money to do a lot. You can get that. Sometimes that's why options are so nice. If you think a stock is really going to do something, and you don't have the money to fully go into the stock, then you can play their options. And you have to go naked if you don't buy the stock. But if you go into the options, the option may sell for a tenth of the price of the stock or even less. And you can play the movements on that stock. So options are very highly leveraged. You can make a lot of money, and remember, leverage works both ways. You could lose a lot of money. So you better be pretty sure. The disadvantages is the premium's non-refundable cost up front. So there's opportunity cost. You could have put that money you're paying for this premium somewhere else. Because remember, if nothing happens, if rates don't go above that, you just paid a premium. It's kind of like life insurance or car insurance. If you never have an accident, sometimes you wonder, why did I pay so much in premiums? Because you lose all those premiums. But then the first time you have an accident, you know why you paid all those premiums. I said I had an incident last night that I never have. I have a pretty new car, so I never even thought about going with RACV because I'm in a lease here at the university, and they provide the insurance and everything. And so I'd never joined RACV, and last night, coming around that little circle down there by the YMCA, yeah, they have a little thing that juts out. I was just coming around it. I did not see that there's a big triangle juts out, and I hit it. And I blew my tire. So I called the RACV. They wanted $400 to come change my tire. Found a student to do it for 50. So found 2 professors to help too for nothing. So the students' time was more valuable than the professors. So I didn't think I'd need it, and since the cost of joining isn't much more than $90 a year, I now see maybe I should get one of those road assistance groups. Caps can also lose all their value if they expire as out of the money. And that's the same thing, they expire worthless. So if you're the buyer of a cap, you just lose your premium. If you're the seller of the cap, then you get to keep the premium. It's high potential losses for riders. It's always the riders that take in all that, because they lose that. The thing about selling an option or being a rider of an option, whether it's a put or call, either one, you don't have that right to use the option. You have to. So if you're the rider, if the buyer of the call option exercises, you have to perform. So you don't have that same right. There's more of an obligation placed on the riders. And the bid offer spreads can be quite wide in these types of instruments. That's because the riders want to make some money. Some of the cap strategies are to buy out of the money caps for a small enterprise, if it's a small company. And remember, this is a trading strategy, not a buy and hold. So they take high strikes out of the money caps cheaper. They're always cheaper. The higher the strike price and the further out of the money, the cheaper the cap is. Because as we get closer, there's less risk. Because the closer we get to maturity, it's more accurate. So it's a lot of smaller enterprises will actually buy very high strikes and roll over to higher and higher just to keep the cost down. Another one is thing they do is corridors, and this is the cost of purchasing the cap is offset by simultaneous sell of another cap with a higher strike. So rather than putting a floor and a ceiling, you're creating a corridor of interest rates, and both of them are caps. Neither are floors. And then you work those out through the life of how long you want things to go. A corridor payoff is you actually buy the first cap and it stops and you're in that, and when it expires then the second cap stops and then you go into another one, and you just keep putting one further and further out and keep what we call rolling them over. I do a lot of this with currencies in particular because there's a lot of risk for me right now with the US dollar, so I'm trying to maximize what the Australian dollar is at now. So I'm actually, even though I'm somewhat losing right now because it's gone higher than I expected to, I at least have created a price at 107, I think, that I'm set. all my Australian money I can get turned into US at 107. Which is important to me since all my income's in Australian right now. Sure makes my pay look better. Another one is a step-up cap, and this is very similar to the corridor, but those are used only usually when there's a very steep yield curve. Remember, that's when interest rates at the lower term to the higher term, there's a very steep curve. Steep yield curve environments, they're going on now. You raise the strike of the later caplets to reflect the higher forward rates. So you actually have several going at once. It's just a way of locking in, for me, it's so I can, and for a small business, if you have international money you're dealing with, or if you have international interest rates you're dealing with, it's just a way of planning better. I know where I'm going to be down the road. A floor is what caps are to borrowers. So this is for investors, this is what caps are to borrowers. It's a hedge against decreasing interest rates or downside risk. Remember, lenders don't want rates to go down, especially like in a floating rate environment. If their loans are all out there in a floating rate, as rates go down, so does their return. And so they want to ensure that they at least keep what they started with. You ensure you receive a minimum level of interest. You nominate the lower rate. Again, you never make it the same as it is right now. You try to create a little stop loss. Okay, I can handle a 0.5% or a full % lower. So that's where I'm going to put my floor. It closely resembles a portfolio of put option contracts. Remember, a floor and a cap are not just one option usually. There's several. We call them caplets or floorlets. Floor payoff is just the opposite of a cap payoff. You're stopping at the floor. You won't let it go below that. Anything below that's a gain to you. Somebody's going to pay you. The insurance you bought is going to cover that. Bring you back up to that line. Now, a collar combines both a cap and a floor. Remember, a corridor is two caps. A collar is a cap and a floor. So all you're doing is locking in a range. It's an interest rate band. It reduces cost because you're selling one and buying the other, so you're getting money for one and you're paying for the other, so you offset the costs. Not always zero, because sometimes that premium is different. It depends on what your collar is too. But what you'll find is oftentimes in the type of environment we're in now, floors have a lower premium than caps because the expectation right now is that those interest rates go up. And so there's more chance of the insurer, the person that sold that cap to you, is going to have to pay. So he'll charge a higher premium. But you offset it quite a bit, and so it really reduces the cost. The borrower buys caps and sells floors. A lender buys floors and sells caps. And all you got to do is think about it. If I'm lending, I want higher interest rates. If I'm borrowing, I want lower interest rates. So you want to protect against the opposite of what you want. So if I want lower rates, I want to protect against high rates. If I want high rates, I want to protect against low rates. So then you don't have to remember. Just think of it, just think what a lender does and a borrower does and how they make their money. The last one is swaptions. These are options on swaps. And we've got options on everything now. They're known as entry and exit options on swaps. They give the holder the right but not the obligation to get into or out of a swap. Because remember what a swap is. A swap is an obligation. And you don't know, as much as we plan and we make our expectations, there's always the chance something goes wrong. So if you're not sure, and most aren't sure, then they say, well, I just want an option to go into a swap. I don't really want to do the swap because I think things could go against that, my swap. So I just want the option in the future to take this on. And they'll get that. The buyer will get that right. A call swaption, the buyer has the right to buy a swap by paying the exercise price. It's called a payer swaption. It's payer swaption. The seller is obliged to sell the swap for the exercise price. So remember, again, only the buyer has a right. The seller is obliged. Now, if the buyer chooses not to exercise, the seller just keeps the money and runs. A put swaption, the buyer is the right to sell a swap for the exercise price, and it's called a receiver swaption. We'll come back to this afterwards. I put these on there just for some of you that wanted to see some of the different types of spreads and stuff you can go into. It's just for you to look at, and I think you already had exotic options, but this was kind of nice because it talks about bearish, neutral, and bullish market direction, and what the implied volatility is, and then what you should do. So I thought you might enjoy seeing that and start putting it together. Because the thing is the way that units taught sometimes, you're learning these things disjointly about the volatility in them or about market directions. And this, I just thought you want to see a little chart that puts it all together for you on using options. Options, you do yourself a tremendous favor. You do yourself a tremendous favor if you, even on your own, figure out, learn more about options. It's extremely active. Every level of finance is using them. Banks, countries, reserve banks, any level of the finance industry, there is some use of derivatives. And the problem is students are not learning about them. And so if you want to get hired and you can show you have some advanced knowledge in derivatives, you've done yourself a tremendous service. At the very least, learn the language. For those of you, how many of you did the basic option stuff? Did you? None of you. Did I go through the other day my option stuff and show you why they use the log normal and stuff? Yeah, I did. Okay. Get that. Go through that. That's the language. And get every one of you, if you're truly serious. When I first decided to go into finance, my undergraduate degree was in accounting. I hated accounting. It was the boringest thing in the world. And I was a top student. But I immediately went to work for a brokerage firm. And by the time I'd been there 1 year, there are several books I had on my shelf. And one of them is Hall's Introduction to Options. And I moved up quite quickly in the industry. This was years ago when options were just becoming quite lucrative to brokerage firms by teaching myself. All the language. Didn't need to do the math. I could set up a program in Excel to do the math. But I learned everything there was I could on options and derivatives and made a place for myself. And then I took that and then started my own firm. And then I sold my firm and started a risk assessment firm and started teaching the average person how to hedge and protect themselves through the use of derivatives. Because derivatives, whether you like it or most people think they're speculative. That's not what they're supposed to be about. They're insurance. And if they're used properly, you can really protect yourself and make some money. So take some time on your own, because a lot of these master's level units just give you bits and pieces. But I would highly recommend that you get yourself familiar at the very least with all the language. Understand what they're talking about when they say strangles and head and shoulder, straddles and butterflies. Because that's how they're talking out there. So if you go in for an interview, they're going to see if you do know what those things are. And they're looking for people with that kind of skill in derivatives. Okay, last topic for this unit is credit derivatives. And it's not a very long topic because, again, all the credit derivatives is the same types of instruments as you had for interest rates. Now we're just going to trade in credit. So the most important thing is, what is credit risk? Well, any of you who have loaned money to a friend and you haven't seen them since knows what credit risk is. I mean, how many of you have done it? I mean, we've all got the friend we loan some money to, and then we don't see them because they owe you money. Kids too. The credit risk to loaning to children is quite high. But you expect that. And I discount that credit risk. You have credit risk when a bank loans money to you. In fact, what does he do first? Do they just hand you the money? What do you got to fill out? Forms. Because they have some model they use to determine what type of credit risk you are. A company can offer credit to, you can tell I did some of these fast. It can offer credit to purchasers. So if you have a small company and you're supplying other companies, you may set up a credit where they don't have to pay for 30 days or 60 days or 90 days. Some companies issue bonds. Remember, when you buy a bond, which of you is going to have to worry about credit risk? You or the company? You. You're lending money to the company. Bonds are not risk-free. You better understand the company. That's why they rate bonds. These are often called non-performing loans. The reason we call them non-performing is there's no performance involved. You don't have to do anything. We're basing the loan on your credit. Now, oftentimes they're collateralized, but the loan itself was given based on your credit. Or, say, if you're real young and you've never had credit, perhaps they ask you to get a cosigner, and it's based on that person's. They're transferring the credit risk to the cosigner because they're responsible for you. There's only one thing worse than bad credit. What's that? No credit. You can actually get a loan more easily if you have a little bad credit than you can with no credit. And so some of you that are very young and haven't had many, I don't recommend I'm astounded how companies are handing out credit cards to young people at university, and you're running up debts, amazing debts, while you're at university on credit cards. But if you aren't one of those people that does that, then the very least, do take out a little credit card, put a limit on it, even put the money up front if you want, and make payments. Because if you're one of those people that pays your whole bill off every month, you're not establishing any credit. Because credit means you have shown a pattern of paying payments. In fact, credit card companies don't even like you if you pay every month. You're not one of their favorite people. So at the very least, take a little credit card out, cap it at $500, go out and buy a couple things, and make payments. So you start establishing a payment record. Because it is hard to get loans, and especially as credit tightens, which is going to happen. Right now in the U.S., all those houses for sale, there's tons selling at 40 to 60 cents on the dollar. Homes that cost $1.5 million here can be bought there for $250,000. But nobody can buy them because the credit has tightened up so much it requires huge down payments now. And even if you have unblemished credit, they're requiring huge downs because money's tight. So credit is an important thing to you and to everything you deal with. Some of the repayment substitutes for repayment can include guarantees. Again, that would be like a co-signer or somebody who endorses your loan. Collateral, when you buy a car, what's the collateral? Or if you buy a house, what's the collateral? The asset. You don't pay, they take your asset. Now, that's why you can get a house loan at a much cheaper rate than you can get a car loan. Because car loans, what's happening to that car? It's depreciating, and I mean quite quickly. And the other thing is they always say is, you got wheels. You can take it off. It used to be funny, in the U.S. when housing was pretty tight, the mobile home became, and they weren't really mobile homes, they were houses, but they actually have a trailer underneath. I mean, they're big houses, 3 bedrooms, 2 and 3 baths, but they sit above the ground and underneath's a huge trailer. They can be moved. The interest rate on those were huge because what they were finding is people were just taking off with the whole house rather than go have it repoed. The other thing that's important when it comes to repayment is the recovery rate. Even if a company declares bankruptcy, or even if you get your car repoed, most companies have already established what their recovery rate is. How many cents on the dollar are they going to get back? Now, when it comes to your car, oftentimes they're not too worried because they're going to sell it, even if it's at a loss, and come after you for the balance. In your home, they're usually okay, but the sad thing about your home is they often will sell it for the payoff. When in fact, if you'd have sold it yourself, you might have made some money and paid the house off too. Now, this has been one of the major issues in the U.S. People are owed more on their house than it's worth because they took all these subprime loans on their homes. They took all these second mortgages to actually, in some cases, to enter the market. And so they have an asset that they may owe twice as much on it as it's worth. Now, in that case, the bank doesn't want it because they don't recoup either. So again, when you get in trouble, talk to the bank. They don't want your asset. They will work with you. Massive in the U.S. people going into the bank, and the bank willing to even reduce the amount of principal they owe. Lowering the interest rate. Extending the loan. They don't want it. They're not in the real estate industry. But if you'll notice, all of you that took your accounting courses, there's always in every set of books for any company, there's a set of uncollectibles. right? So they have a model. They expect to not collect everything. Some of the credit events that they worry about, the first one would be bankruptcy. And in that case, now they say the company is dissolved, but in some countries, I don't know about here, there's two types of bankruptcy. I think here there's just one type of bankruptcy, but you have a reorganization way for a company to go. In the U.S., we have Chapter 11 and Chapter 13. Chapter 11 just means you want a breath. Stop, creditors, leave me alone, give me some time, I'll straighten things out, and then we'll pay you. And usually then they negotiate with all the creditors, and maybe they pay 70 cents on the dollar or whatever, but they come back as a good company. They start practicing again. Chapter 13 means I'm done. I'm not paying, I don't have it, you can have the company. And that's when then the lender goes in and sells everything they can to get back as much as they can. The other one is failure to pay. This is often the one when you have your friends. You remind them and you remind them and you remind them. That's when they quit seeing you. And they just do not pay. Significant downgrading of credit rating. That just happened yesterday in the newspaper. What got downgraded yesterday? How many of you watch read the major news for finance? Again, if you're serious about being in finance, you should be at least looking at the big headlines on the business pages. Downgraded all the major banks here yesterday. Westpac, all the big ones. S&P downgraded them all. The problem is all the major banks here are having to borrow all their money in foreign markets. And that's not a good thing when your currency's where it's at. So it's very important to you. The credit rating provided by an agency falls below a specified level. Another thing that can happen, if your company is a stock owned by super funds or a stock by some kind of mutual type fund, they often have something in their bylaws that actually says if that bond is below a certain rating, which is usually BBB, you can't have it in this fund. You can't buy it, you can't own it. Because anything else below BBB is considered speculative or bankrupt. And so they have to sell. Now, I will give you guys a little note on that. There's a lot of money sometimes to be made in D-rated bonds. Now, let me explain why. Oftentimes, a company was a real good company, but got some event, it's usually some kind of litigation, huge court case where they're going to have to pay, and they declare bankruptcy or reorganization. And what they do is immediately the rating goes to D. All these mutual funds and supers sell them. So the price of the bond may get down to 20, 30 cents on a dollar. Now, if it was a good company before this happened, it's going to come back as a good company. So if you really watch those, one of my favorite ones was there's an oil company in the United States called Texaco. And back in the early 90s, there was this huge litigation case, and it was done in Texas. And it was all based on a handshake between two guys. And they sued the guy that shook the other guy's hand. They sued and they won, which was ridiculous for a big company to have some contract honored over a handshake between two men. But the case was huge. Texaco immediately declared bankruptcy, Chapter 11 type bankruptcy. The stock went back to from 25 down to, I want to say 8 or 9. The bonds went to about 30 cents on the dollar. I bought all I could get my hands on because as soon as they reorganized, it went right back to $1,000. And the stock flew past that because in the reorganization, they changed how much they required Texaco to pay for this suit. And it was about 10 cents on the dollar to keep the company from going under. You didn't even have to wait a year to get 5 times your money. So don't always discount something because it's D rated. Take a look at it. If it's a good company, it might be worth looking at. They may be having some liquidity problems right now, but they just need a breath, and they'll come back. Sometimes there's a credit event after a merger, government action or market disruptions. That could be maybe you have a company that's in a foreign country and they confiscate your assets. A lot of this happened like in Argentina and stuff at one point. The effects of wars. These things are major credit events that can really change the outlook for a firm or even a country. They're usually driven by either market risk or company-specific risk. Under market risk, there's really two. The market as a whole, so the market as a whole is going down, but also there can be an industry risk. A lot of times, if the market's really booming, things like, it's unusual times now, but in the old days you could count on if the rest of the market was booming, the gold market was going down. And then when things got tight in the regular market, the gold market started going up. Now the gold market's going up no matter what right now. But it used to be, it was called a flight to quality. So if things look shaky in the economy, people wanted gold. Gold's something you can feel, see, and gold is gold. And so there are a lot of people, that's why oftentimes the industry that was the gold industry worked completely opposite to the rest of the market. Company-specific risk. When you look at an industry, there's always good companies within that industry and poor performers within that industry. It's probably better to even look at a company based on its performance within an industry, not the market. And look at an industry compared to the market. Credit risk is the risk of loss arising from some credit event with the counterparty. Remember, the only thing we ever worry about with swaps and forward rate agreements is counterparty risk. And credit risk is the risk there is with a counterparty. Will they pay? Will they perform? Credit risk is often referred to as default risk, because that's what we're worried about here. Not so much that an event occurs, because the event could occur, the credit event could occur, but the company still has the ability to pay because they're very liquid. So what we worry about is that they can't pay. They default on the loan. The credit spread is most credit managers spend a lot of time developing what we call credit risk models. Most models are based on two fundamental concepts: the probability of default and the recovery rate if they do default. And as one measure, it's a little summary statistic that we call credit spread. Just like when we had yield spread, the difference between the short term and the long term, now we have credit spread. That's the ratio of the probability and the recovery rate. And what they do is when you fill out all your paperwork at the bank, then they run it through this model. We'll do it. I'll come back. They run it through this model, and it gives you a score of some type. And that's how they determine if they're going to give you a loan or not. They're not foolproof, but there's probabilities involved. One of the ones most common that all of you should have heard of, and if you are out there actively buying things, company bonds, country bonds, any type of instrument like that, is you should be very aware of Moody's, S&P, and Fitch. These are three established ratings agencies. That's their whole business. They rate. Moody's and S&P, very similar. Remember the best are AAA. D means bad. But do not place everything on a ratings agency. Does anybody know what Enron's rating was, or WorldCom? AAA. These are based, remember, on balance sheet items. So it's based on the information they have. If there's any fraud in their accounting system, it's not taken into consideration here. And in fact, S&P now has a disclaimer about their rating because of Enron, WorldCom, and all those big. What was the ones here? Centro, and was another big one. I've got them here, I think. There's a couple big ones here. AAA. They're rated as either investment grade, non-investment or speculative grade, your C's and stuff below, and junk bonds. Junk is D. Again, a lot of people make a lot of money in junk. So if you're risk averse, you're not, like, once you get my age, you get 60 or above, you shouldn't be in junk. But when you're your age and you got time, if you lose, to make the money back, you might look some junk. You can be more speculative. You have a longer investment horizon. So if you're ever going to speculate, now, once you have children and families, your speculation goes down. Once you get close to retirement, speculation goes down. So it's that life cycle. You're right now in the life cycle. If you're ever going to speculate, now's the time to do it. I never did. I can't say I never did. I took some, I call flyers, but it was always had this set a little bit of money off to the side for playing with. And that's, and I ran that up to 1.5 million and right back down to 100,000 in 1 year. So I really wanted, and that's how I learned. It was my money to learn with. And that's when like I said before, that's when I tried things like pork bellies and oak contracts, and because I didn't know anything about them. I wanted to see how they worked. Some other things, there's country debt. They're usually are rated as sovereign debt. They're usually considered safer. You don't get as high a return because it's usually either the state or the federal government is behind it. But there's a lot of that in trouble now in some countries. They help to inform investors, but they are not an insurance against default. Again, this is just one place to look. If you're worried about the company, then you have to do this. Find some way of insuring it through some type of credit derivative. The method these agencies tend to use is off the balance sheet, and it's all based on historical. Remember, just because they've never had problems in the past doesn't mean they're not going to have problems in the future. But everything in a credit rating agency, everything when you go to the bank and you fill out that form is based on your past history. Now, you could legitimately go today, fill out the forms, you got this wonderful job paying, and tomorrow lose your job. But you got the loan based on today's information. That credit event that happened to you, the bank doesn't know about. So their decision's based on that picture of you at that time. The problem with this is, again, news events lag. So you put your stuff in today, you lose your job tomorrow. You didn't call the bank up and say, I lost my job, you want to change my credit app? No. So they're not going to find out about it for quite a long time, probably. In 2002, 2 months before the collapse of WorldCom, its credit board spread was exactly the same as Ford, which was a AAA. It went down too. This is almost funny that they put these two in here, and IBM, because it's in some trouble now. And then suddenly it jumped. It was unexplained. It was AAA rated. Well, it's because there was a lot of fraud going on. Credit risk instruments enable financial institutions and companies to transfer credit risk to a third party. Again, if you have your parents endorse your loan or co-sign for you, the bank's not worried. The only credit risk they're taking is with your parents. Your parents are taking over your risk and you're the higher risk, so the bank's perfectly happy. And it reduces exposure to the risk of and obliges default. And I guess there's a paper in there for you to read. Check those papers are really good on this. So. Getting it wrong, though, is very costly. Here's the two from here. Subprime, the big event in the U.S., is an example of incorrectly priced credit risk. Credit was so easy, anybody could get it. People, again, if they could, were going in, just like here, housing prices were going up quite well. Now in the U.S. we have housing cycles. We all know they can go down as quick as they go up. It hadn't really happened here yet. But in the U.S. there's quite a cycle with housing. And people bought these houses, maybe they paid $150,000 for it, and the value of the house, say, had gone up to $250,000 over a couple of years or something. They were actually going in and getting another mortgage on their home at the higher valuation. And then taking that money and putting it in the market, because normally if housing prices are going up, the market's going up. So they were actually mortgaging their home to play the market. And what happened is people had such huge mortgages on their home, and most of them had floating rates, which wasn't an issue when rates were going down to zero, but at that time they weren't. People couldn't pay the payments. There was massive foreclosures. But when you look back, the subprime market, these people should never have been allowed to get a loan. Their credit wasn't there. It was so freely handed out, and so like a control. I honestly believe that the banks were the ones that should have been allowed to go under, not the people that had the assets, because it was their fiduciary responsibility to make sure these people qualified for loans. I was very upset that the government stepped in and covered all the banks and let the people drown. Those people should have been told no. There isn't anybody who doesn't want a nicer home. There isn't anybody who doesn't optimistically think they can always make those payments, and they're not going to lose their job. And so I think, in a sense, that it should have been held, the bank should have been held more responsible for the issues that happened. One here was Opus Prime, was the other big one, I think. Oh, shoot, this happened yesterday, too. Let me see. Yeah, but I'm going to go to Central first, because I think I had Opus Prime. I had a little problem getting in yesterday, too. It comes up a bit later, but it... Oops. Can't spell my name. I've got the links for you. That's why I did put the slides up for you, everybody. If you saw, you can just click on these and get it. Centro was, everybody knows what the Central malls were and stuff, don't you? They did a complete collapse here. And it at first only admitted it was struggling to refinance. What was happening is it wasn't a bad company. I mean, there were some management issues. But what happened is they couldn't borrow money to pay short-term bills. So it was a liquidity crisis. And so when credit gets tight, even a good little company, and this will happen most in small to medium firms, you're a good company, you've got a good product, but for some reason some extra bills came due this month, and you're in what we call a liquidity. Maybe you got some revolving credit, and maybe you've only got $200,000, but this month you have $250,000 worth of liabilities, and nobody will give you that additional 50. So what happens is you go behind, and that can compound. Maybe you had to go pay some high interest rate to take it. This can become a serious problem. It's usually a liquidity problem. You just need to get past this, and then you're a good company again. Well, they had trouble finding anybody to refinance their short-term debt. I would assume it's because maybe their credit rating had gone down. Or banks had increased their credit requirement, their score. And it led to a complete collapse and a freeze of all its funds. So if you want to read a little more, if you just click on that in the set of slides, it'll take you right to this. And the other one was Opus Prime. I think it'll come up easy now. It wouldn't. There it is. It wouldn't come up as easy before. When you're on mine, when you're on your own, you'll be, now this is not going to come up again, so I'm going to, but you guys get on and read about it. I think all you need to know is that these things happen, and it can be a serious event for the company. And these are not predictable. One thing that happens often is a firm that is very dependent on the owner's participation dies. And people don't realize how much of the value of that company is placed on that management. And they can actually then require you to put more down, put more money up, put more collateral up. Because then they're a little scared, because this guy who's run this company so well, and now his kid's going to take it over. His 22-year-old kid's going to take it over. They get nervous because it's an unknown. So they can change the requirement. There usually is a codicil that if some kind of management changes, that the loans can be renegotiated if they're big. What a credit risk model is, again, there's tons of models. Every bank probably has its own, but in anything that's involved, the inputs are usually conditions of the economy. How's things going out there? Is it? Australia has one of the strongest economies in the world now, so things are good right now. But banks are still getting nervous because I see a tightening of credit going on here. And so I don't know if the business is starting to pull back. Conditions of the firm, and not just the firm. If it's you taking a loan, your conditions. And they throw it in this model, and it's kind of like a milkshake. I put in my stuff, and I put it in the blender, and out comes this nice milkshake. And the output is things we call your credit spread, your credit rating, or for you personally, your credit score. Now what happens, something changes on this side. You add another banana over here than you usually do. Well, once you're all up, and over here you got a milkshake, but it tastes totally different. Got more banana in it. So that's constantly changing. How many of you have checked your credit score? Let me tell you something about a credit score that a lot of people don't know. Every time you file for a credit card, apply for one, your credit score goes down. Because the assumption in your credit score is that you have that credit card. If you're accepted, now you may get it and say, I don't need this, and tear it up. They don't know you tore it up. They know you've got a credit card with 5,000 or 10,000 credit allowance on it. And so if you have 5 or 6 of those, they get worried because you are actually beyond what you can pay if you charge them all. They always assume you will charge them all up as a person. So if you're one of those people who keeps getting these new ones that gives you that 6 months introductory offer, if you transfer a balance, make sure you've closed out this one then. Don't keep both credit cards. It hurts your credit score. So then if you have this one that had, say, a 5,000 allowance, and you got this new one and you transferred that over to this one and it has a 10,000, they assume you have 15,000. Because most people will end up charging both up if they have them both. That's the risk. So every time it will affect your credit score. The other thing is, it's very important for you to keep track of your credit score. And here's another reason. It's the easiest way to find out if somebody else is using your credit. If you get on there, it actually tells you when somebody has actually applied for some type of loan. So if somebody has intercepted some offer from Visa, knows your details, so fills it in, sends it in, gives their address to send the card back to, you can see it happening there. Keep track of your credit. It goes everywhere with you. And that's how all of these people get away with stealing your identity, because you have not even checked. Because remember, they can't use your identity and get money without going through the credit agencies. Everything is posted to them. It can be a month or two behind. But you need to know what's going on with your credit. Sometimes you'll get on there and say, geez, I have absolutely no credit. And that's what a bank's going to see too. But I've been doing this. So maybe you're not paying off the right way and you want to change it. You have got to keep track of your credit your whole life. Nobody else is going to. And if somebody steals your identity, now, sometimes you can't catch them until they've had it for 5 or 6 months. But remember, nobody's going to catch it but you. And there are people that have had other people actually getting credit on them. I know a very good case of somebody who went to buy a new home and was denied their loan because they were overextended. They had no idea. Now, whoever had stolen their credit was paying their bills, but there were so many credit cards in this person's name and so much credit out there, they were overextended and couldn't get a loan for their own home. Somebody had stolen their credit. Now, that's the way they do it. Some of these people, it's because they can't get credit. But if they get overextended, what do you think they're going to do? Once they use up the credit they stolen from you, they're walking away and you're stuck. It's yours. So watch your credit. That's yours. It's like your name. It's like your personal identity. And nobody else is going to keep track of it. So if none of you have looked, you better look. You might be shocked what's on there. So what are credit derivatives? They're derivative instruments that seek to trade in credit risk. Remember when we were doing interest rates and we did a swap, we were just swapping floating for fixed. We took our preferred habitat and our I can't remember the name of the one that we should be in because we have the best opportunity of making, and we swapped them with somebody else. Same thing here. We're going to swap credit risk. This is why I said take some time to learn about these things. Look at how much are being used. And I would say, and if we go out to 2009, 2010, because the new numbers will come out, they may even be out. I went to look, they weren't, but they may be out now. I would say it's gone up even more because there's fear in the market. When you start talking about countries' credit being downgraded, they downgraded, was it Iceland again? Or they're about to downgrade Iceland again? In Europe, several countries are in trouble in Europe with their rating. These derivatives are becoming more and more important. And their use, if people are nervous. I mean, when I had my own firm and stuff, I never used anything. A shake of a hand was credit back then. You trusted people more. You can't now. Even the best companies run into trouble. Best countries run into trouble. Best banks run into trouble. The types of credit derivatives that are most common, there's tons out there. It's just like any derivatives market. There's so many products out there now, I can't keep up with them. But the most common are some form of these three. Credit default swap, a credit spread option, and a credit linked note. Those are the most common, and there's derivatives of these derivatives all over the place, but these are the most common. A credit default swap is just like we talked about the interest rate. It's an over-the-counter agreement between two parties. It transfers a defined credit risk from one party to another. It's an insurance. It's actually, you pay a premium and you got insurance against them going bankrupt. People you loan money to. The buyer of a credit protection pays a periodic fee. Remember, a premium? Any of you that have insurance, you pay that premium every month. That's all this is. You pay them a premium, and they protect you from that person not paying. And for the event of a credit event experienced by what we call the reference entity. That's the person you've loaned to, or the amount you've loaned. The seller may have to pay if a predefined credit event occurs. So if the credit event is bankruptcy, then that person you paid the premium to has to pay. Just like your car insurance, you pay those premiums. If you never have an accident, they never pay. The minute you have an accident and it was your fault, then you have to pay. They have to pay because the event happened. Just a little word example. Suppose Bank A buys a bond which is issued by a steel company. And they want to hedge against default of the steel company. This was a big issue back in the late 80s, early 90s, because steel companies were going bankrupt right and left. Bank A buys a credit default swap from an insurance company, C. Bank A pays fixed periodic payments. Now don't get confused here. It's no different than insurance. So even though we call these swap and stuff, it's you paying somebody a premium to be insured against an event. Life insurance, you're insured against the event of death. RACV, to insure you against the event of needing help on the road. I mean, these are all insurance against an event. They're no different. Just have fancy names for them in finance. And the other thing is they're sometimes very formal and sometimes set up by a bank. A bank may require you. I don't know how it works here because I haven't bought a house and had a loan on it here. In the U.S., you have to have mortgage insurance. You have to. The bank requires it. So there's no option here. You have to get that. They want to swap the chance of default. So they require you to purchase mortgage insurance. Now that goes to several levels. One could be that the mortgage is paid if you're sick. One could, so you can get a disability, different levels of mortgage insurance. But for the most part, it usually is against default. That's all the bank will require is against default, because that's all they care. If you don't pay, this mortgage company, the insurance will. And that's a swap. Bank's making you pay for the swap. So the Bank A pays a fixed periodic payments to C in exchange for default protection. It's just an insurance policy. This looks like anything else.
Can I ask something?
Yeah.
If although the insurance insures the asset, but in the credit default swap and signing it insures it basically many times, right?
Mm-hmm.
So in the event of a default, isn't it very, very risky for the insurance? Because if I insure a house and I default, it's one house. Mm-hmm. But if I sell the credit default swaps
all they want.
Because there is some document that shows that the house has how many mortgages or which person the house.
Yeah, but there usually should be an amount there, and they should have reached, that's why you do title searches. Because oftentimes, even you go buy a house, and you don't realize there could be even a builder's lien against that house. That's why you actually do title searches. And it can happen, and it used to happen more, but I think because of the requirements to make sure that all these liens are non-existent, then that can't. Otherwise, if there's multiple layers of it, it usually still adds up to the value of the home. And it's up to that insurer to make sure that they have an asset. And not always is the asset the loan collateralized. It could be a personal loan on the house, and the only one that's going to be safe is the one that has the collateral for the house. But the house is the collateral. Yeah. So that's why you do extensive. Even when you buy a home, you should be making sure there's not some kind of outstanding debt that holds the house hostage. Not the people that sold it to you, the house. And that used to be a real problem with land, if there were actually people that owned everything under the land. I don't know how it works here, but we actually have mineral rights you have to check on, because the mineral rights can be owned by somebody you've never seen or heard from. You only own the top of the land. So if any oil or gold is found underneath, it belongs to whoever holds the rights to the minerals. So you need to find out all these things about the place you buy. Usually a bank does it for you. There's usually a title. And then there's title insurance. So if I went and bought a house, I get title insurance. These title companies told me there are no liens on this house. There's no builder liens. There's nothing on this house. And then I find out there is. They have to pay. Because they've told me there's not, because I have title insurance. So it protects me against. So there's lots of different things that can be insured. But normally it behooves the person providing the insurance to ensure there's some way of getting their money back. The credit default swaps is a huge market. There's over 40 trillion of notional principal. Remember, notional principal means in a swap, there's really no money changes hand. There's only premiums, and in a sense, in this, I guess some money can change hands in the full amount, notional value. But for the most part, it's on paper. The buyer of the instrument acquires protection from the seller against a default by a particular company or country, and that company or country is the reference entity. So whoever loaned them money goes to an insurance company to protect themselves against who they loaned them to going in default. And that one they loaned the money to is the reference entity. So they pay a premium. An example would be if they paid a premium of 90 basis points per year for $100 million, a 5-year protection against company X. Doesn't that sound like an insurance plan? Premium is known in the finance world, not the insurance world. Premium is known as the credit default spread. And it's paid for the life of the contract or until the default occurs, the event occurs. If there is a default, the buyer has the right to sell bonds with a face value of $100 million issued by Company X for $100 million. So if this person loaned $100 million to a company, they had $100 million in some company's bonds, and they put insurance on it, the company goes default, they have the right to sell this $100 million worth of bonds to the insurance company. And then it's up to the insurance company and go and try to recover what they can. Put them on the open market, whatever. Try to recover what they can. Nice thing about it being bonds is that they're higher up the hierarchy in recovering it. It's often why you sometimes, as you get less if you want to take less and less risk, you start moving from shares to preference shares. Then you go from preference shares to bonds. and you move up the chain even with companies. Because if a company goes bankrupt, the way they pay back moves back down that. And the last people to get any money back are shareholders. Ordinary shareholders, you're the last. And oftentimes, man, I'll make sure you very rarely get anything. Unless the government steps in and helps out. So and I don't think they should. You're an ordinary shareholder, you took the risk. So referred to as either buying or selling protection when you're talking about swaps. A seller of protection is assuming the credit risk, so they're called a default swap seller. The fixed payer, the person that's paying the premium, is the protection buyer. And the two things that you have involved are the reference entity, that's the one you're being protected against, or you've made a loan to, and the other one is the obligation, that's the amount. How much are you protecting? See, sometimes you may have loaned them $100 million, and you may only decide to buy insurance on half of that. Or you may lower it throughout. You're willing to take, because it costs less. So it depends upon how you set up the swap. Now, the biggest difference between this, a swap having to do with credit, and remember those swaps when we had interest rates, is those dates. Remember with the interest rate swap, we had all those important dates. You had the initial date, a couple days later you set a rate, a month later you had the first time money changed hands, and then maybe 3 months later you had the maturity. So there's all these dates involved you had to remember. And so the biggest difference here is there's only two things involved. Who are you getting protection against? What's the premium? So if in this case, the premiums paid to the seller, the buyer of credit risk insurance or credit risk swap, pays a premium to the seller, the insurance company, the bank, whoever they're setting up as the seller, and they pay the premium, and if they pay nothing back to the investor, if the reference obligation issuer, that's the company they're protecting against, the one that sold they bought the bonds from, if they get their money back from them, that's it. Game over. 5 years later, contract's over. They keep all the premiums, they get their money, we're all happy. Some of the events that could happen in the meantime, I'm going to go through these quite quickly. These are actually official definitions, and that can happen. Some of you already know. A couple of them I thought I'd explain. Failure to pay, that's easy to understand. Bankruptcy, easy to understand. Obligation acceleration. Obligations of the reference become due. Maybe they broke a covenant. Maybe they did something that they weren't allowed to do, and they're forced to end it, to break the contract. That's a credit event. That changes the whole game. And they have to repay prior to maturity. What is it we call those kind of bonds? Callable? They call them back. That ends the agreement in the swap, too. They're called away. Very common now. Very few companies don't put a call feature on their bonds unless they really have to entice investors. If you're really trying to entice investors, because there's such a massive group of investors in the baby boom age, we don't like callable. And so if you really want to raise some money and you offer some non-callable bonds, you sometimes don't have to pay as much then. And if you're a little higher risk company, it can save you a fortune. Because we are enticed by non-callable. But to me, if they don't have a callable feature, then perhaps there's some other reason. So there's an obligation. They called them in. Obligation default. They didn't pay the interest payments. Default means they didn't make their obligation. Repudiation, a moratorium. They refused to honor their obligation. Maybe there's a contingent issue. Maybe there's a moratorium on paying. A lot of countries, third world type countries, often can put a moratorium on debt. Just keep them. We're just not going to pay any of the interest for the next year or two. And that's another defined credit event. Material adverse restructuring. Now, here's where I said in the U.S. we have Chapter 11, Chapter 13. This would be a Chapter 11 that they restructure, and they say, listen, once they go into restructuring, they say, listen, we know you own our bonds. If you allow us to pay you 2% less in interest, or not pay any interest for a year, then we'll come back and start paying interest again and put the bonds back and still be able to pay off again at full value. Maybe they say we want to offer you 70 cents on the dollar, but it's a restructuring event. Now the nice thing about those restructuring events, in your insurance, you have insured for the whole amount. So even if they restructure and they're only going to pay 70 cents of the dollar, you're going to get the whole amount because you have insurance. And it's the insurance company that's only going to get the 70 cents on the dollar. This is how the different buyers of credit derivatives, the biggest buyer of credit derivatives, banks. Now this didn't used to be the case. Banks were banks. They took in deposits. You were their number one priority. You're not anymore. That's why they have all these fees. You're almost a bothersome to them now. If you don't have enough money, you are paying. And if you come in and use their tellers, you're really a pain. So what do they do now if you come in and use a teller? Charge you. If you don't have a certain balance, they often charge you to even talk to a teller. Because that's not their business anymore. This is. They're insurance companies. They're foreign exchange players. They're in the securities business now, and there's much more money to be made there than dealing with those people, those troublesome people that walk in off the street. Now they need your deposit, but they're not near as important as they used to be. So I was always shocked at you when I was real young. If you had 500 in the bank, if you had over 500 in the bank, you didn't have to pay for your checks, and you didn't have. Now it's up to one of the banks I deal with. In order to get preferential treatment, I have to keep 200,000 in the bank, and then I get preferential treatment. I get 0.25% extra here and there. It's astounding to me what it takes now to get treated like a person. I have $250,000 in them. It's kind of interesting, some of the major players here. We would expect, the problem is banks has overtaken securities firms. Back in the 80s and 90s, this would not have looked like this. It would have been securities firms and insurers that did this. Banks have now become insurers, securities firms, everything. And that's what put them at more risk, too. So those are the buyers. For the protection buyer or the risk seller, remember the protection buyer is a risk seller. They transfer credit risk on an entity without transferring the underlying instrument. There's regulatory benefits. There's reduction to specific concentrations in portfolio management. And they go short credit risk. If they have some stuff that's a little credit risky, they buy protection on it. That's what Super does. That's what Mutual funds do. Because it's in their covenant, they can only carry so much credit risk. Some of the sellers, again, banks are the major seller. Next to security firms, the hedge funds is the one that most notice here. They are probably the reason the market crashed. Subprime, whole problem was probably due to hedge funds. They didn't care. They actually compounded the problem. They made a lot of money putting, in this case, the United States, in serious financial trouble. Hedge funds did it. They actually hoped for it. And through their practices, because the problem with some of these derivatives markets, they didn't have as many controls on them. So that was the interesting one here is the sellers. The risk buyer, remember hedge funds, the word hedge is supposed to mean protect, right? But they're risk buyers. Remember, they may be protection sellers, they're risk buyers. The diversification, leverage exposure to a particular credit. They had huge exposure, but they didn't care. Access to an asset which may not otherwise be available to the risk buyer. Increased yield. The main applications of credit derivative securities is hedging against default of a reference obligation. Default swaps are usually purchased if the default swap buyer owns the reference obligation and wants to protect against default. That's the way they're most used. Gosh, I should have taken a break. As soon as we'll take a break after this. I see everybody needs a little, I didn't realize how long. I'm trying to make sure that I get to your review today. Hence, when owning the underlying reference obligation, the default swap functions as an insurance against default. This is just a restatement. So, if they are looking for protection, they pay money to the seller, and they pay the premium. If nothing happens, zero money goes from the seller to the buyer. If something happens, if we do have a deliverable, there is default, then the money goes back, the protection buyer has paid the premiums and the notional amount. So if you protected $1 million, you'll get the notional amount and the fixed payment stop on that day. So if you buy life insurance, and that's a swap, if you buy life insurance, if you should die, your life insurance premium stop that day, and you get your life insurance. Or your family does. Guess you don't get it. Can't take it with you. Some think you can. My husband thinks he can. Let's stop there, take a little break. Let's take about a 15-minute break since I made you go so long. I'm so sorry. Every once in a while, if you guys just start raising your hands and stretching, I'll realize you need a break. everybody back? We're losing a lot of people. I'm shocked since I'm doing the review at the end. Okay, let's get going and so we can get done. Okay, let's assume a hypothetical transaction between a broker-dealer and a bank. And in this case, the broker-dealer sells protection, so they take the credit risk on 10 million folding autos to ABC Bank. The term of the transaction is 5 years. In return for the protection that the broker-dealer is providing over this 5-year period, ABC Bank agrees to pay a fixed fee of 1.6% per annum payable quarterly. That's their premium. That's their credit default spread. Settlement is physical. Should a credit event occur, then, the bank would be able to deliver any qualifying senior unsecured folding autos paper to the broker-dealer in return for 10 million payment. And the contract and all future payments would terminate. If the credit event does not occur, then it expires when the contract's over. And that's what it looks like. It's sometimes easier to understand. So if before any credit event, so pre-credit event, the broker-dealer, the protection seller, the bank pays them the 1.6 per annum quarterly, and no money goes from the protection seller to the protection buyer. Then a credit event occurs. In that case, the ABC Bank is going to send senior or unsecured obligations of folding autos with notional amount. So it was 10 million to them, who will pay them 10 million. And on that day, premium stuff. So money only goes from the protection seller only pays. It's like the writer of an option. The protection seller only pays if the event occurs. Otherwise, they just keep the premiums. Same with an option. The seller of an option only has to deliver if the option's in the money. Then we have total return swaps. Same thing, except we're now transferring the total return of a specific asset to a counterparty in exchange for a fee. So the expectation is to have a total return from this transaction of X%. Because events can happen and the total return is not there, then they get insurance to make sure they get the total return they expected. One owns the assets and receives a return. The other wants the return but does not want to own the assets. They only want the return. So those are just between the receiver and the payer. They just get the return money. The actual asset doesn't, the one holds the asset and just gives the return to somebody else. They're just selling their return. Swapping their return. Total return swap seller is the protection buyer. The total return swap buyer is the protection seller. The swap benefits both parties. The seller can keep a portfolio of assets while limiting the economic exposure. So if the return is negative, they don't worry. Fees frees up the seller's lending position. They don't tie up credit. Sellers are typically banks. Buyers are typically hedge funds. That's not all there is, but that's the majority. The reference asset can be almost any asset. It can be an index. It can be a basket of assets, or it can be a whole portfolio. Credit spread options refers to a credit spread, again, refers to the difference between the yield of a risky asset and the yield of a risk-free asset, such as a treasury bond. In the context of a bond, credit spread can be outlined as follows. It's just a difference. It's not much different as when we did term structure of interest rates, where it was short-term versus long-term. This is risky versus non-risky. A hedge against changes in that spread. Usually, if you try to balance things, just like we talked about balance sheets with the interest-sensitive assets and the interest-sensitive liabilities. You try to achieve some level of balance between it, so that what's good for this and bad for that balances back up to where you want to be. Same with risk. That's what securitization often is. A bank wants to get some mortgages off its books so it can free up the ability to loan to other people. So they'll take a basket of mortgages. There'll be some good mortgages there, people that pay well, and some bad mortgages there, people that don't pay so well. And they put them in a basket and basically let somebody else take the return from that. And it frees up their ability to loan money. Because there's usually some fiduciary responsibility to maintain a certain level of liquidity and not have everything in loans. In credit derivatives, the payoff is the maximum. If the payoff is the maximum between the spread and the strike spread and zero, that's a credit spread put. So a credit spread put buyer profits if the spread widens, which means that profits if the yield of the risky bond increases or if the price of the risky bond decreases. Remember, relationship between bond prices and interest rates, if one goes up, the other goes down. So this makes total sense. So as long as you know that relationship, if you had blanks in here, you should be able to fill in the blanks. Doesn't matter what the instrument is. The terminology of credit spread options focuses more on investors' position in the fixed income securities. So if you assume they own a 4-year Argentina bond denominated in U.S. dollars with a notional amount of $5 million, with a price of 100, the coupon and the yield are identical at 7%. The duration is 3.62 years. Remember when we talked about duration? The current Treasury bond yield is 6%. The person that owns this, is worried that the bond might decrease in price or default in the next 3 months, which a lot did in Argentina. As a hedge, the investor buys a credit spread put with a strike spread of 2%, a notional amount of $5 million, and 91 days to maturity, because he thinks it's going to happen within the next 3 months. And if you use the Black-Scholes model, which we're not going to do, the premium he had to pay for this is $17,333. And that was in the Black-Scholes model. The implied volatility of this is 150%. Way beyond the needs of this course. But that's how they use them. Options is all about volatility and excuse me, and setting up the and the time and setting up a spread. If the bond then went from 100 down to 84.81 at option maturity, since the bond price went down, what do we know about the yield? It goes up. So it went from 7 to 12%. Then the investor has lost $759,500 on the decrease. It went from 100 down to 84. So they've lost $759,500 on that decrease. So if we assume that the Treasury bond yield is steady at 6% at option maturity, the payoff in this credit spread put is $724,000. Quite a difference, isn't it? The investor mitigates the loss through the gain. So he got most of it back because he had that little spread in there. He's willing to lose a little from the credit spread option, but still suffers a loss of those premiums he paid of $17,333 and the $35,500 difference at maturity. You go back. See, he had lost $759. He got $724. Is the value of his put. So he still lost. What is it? 52.8. But that's much better than 759. So it's like in insurance, it's like the deductible. You had a 2% deductible. Does that make sense to you? So he paid his deductible. It should be mentioned that it would be appropriate to use the duration at option maturity. But since this is totally unknown, we often use duration for all these problems at the start of the option. So again, there's a whole bunch of expectations there. Realize that. Actually, the true price of this put should have a known duration at the end. But we can't have that. So it's an expected duration. And often they use the day you start the position as the expectation of the future. So they look like this. Again, pay the buyer pays that premium. You know, when you sell a put, you get money. When you sell a call, you get money. The buyer of the put pays a premium to the seller, and the bonds, if nothing happens, then the bonds, they just get their $5 million from Argentina. Credit spread option hedge credit default risk and credit deterioration risk. Remember, credit can change in an instant. Your credit can change in an instant. Again, today you got a job pays $150,000 a year, you get laid off tomorrow. It's a huge change in credit. That's a huge credit event. An increase in one of these risks leads to a price decrease of the reference asset. Your credit. It leads to an increase of the credit spread put option. If an interest rate change leads to the same change in the yield of the risky bond and the yield of the risk-free bond, credit spread options do not protect against market risk. If the whole market goes down, they don't protect because that's not default. That's not what you insured against. The market going down. Or interest rates go, if it's not an interest rate, it's just their credit. You're not protected against the market crashing. Since in the case the credit spread remains unchanged. All things being equal, the spread will stay the same. If an investor is short the reference asset, and wants to hedge against a price increase, he can either buy a credit spread call option or sell a credit spread put option. Always think of it, if I buy a call, I expect something to go up. If I sell a call, I expect it to go down, but I'm limiting my gain. If I sell a put, I'm expecting something, buy a put, I expect something to go down. If I buy a put, I'm expecting to go up, but I'm limiting my gain to the premium I received. Collateralized credit products. So instead of investing in an individual's credit risk or a firm's credit risk, we can choose to invest in slices of risk known as tranches. Collateralized loan obligations, collateralized mortgage obligations, or collateralized debt obligations. To me, they're all the same. It's just whether if a mortgage is a loan, and a loan is debt. So it's just if you're at the bank level, the personal level, the firm level, just depends where you are in the chain of finance, what you would call them. But these are traded also in the OTC market, the over-the-counter market. There's not much transparency here, and that's what led to some of the subprime problems. Banks didn't carry them on their books even, right? And they threw different kinds of mortgages in the basket. And there was more risk there than they ever assumed. But that's just because there was not controls on that market. Hedge funds were not controlled at all. They are a little bit now, and I think it's going to get more serious. But if you want to really read about subprime, this is an excellent article, but there's also, let's see if I can find the name, there's a new movie out. Where did I write that? Well, I'll see if I can find it in a minute here, but there's a new movie out that's all about what happened. It's excellent, and it's a little more fun to watch a movie than it is to, if I can't find it, does it? Inside Job. Excellent movie. Want to know what happened? Watch Inside Job. And it's a movie, so a lot more fun than watching me or a slide. So even the Enron, Smartest Man in the Room, it's all about what happened at Enron. Excellent movie. But it tells the story just like it happened. And there's an excellent one about who was the one that brought down Barings Bank? Because trading derivatives, currency trading. I'll find the name of that movie. There's an excellent movie about that. If you actually see the book written about the events, follows it to a T, but adds all that neat stuff in between that you don't get in a academic presentation. But the movies actually are very good at following the actual events. So if you'd like to learn about these things more in a more fun way, catch some of those movies. Getting a little look, I think I already showed you this, was the global scenario about how much they're used. And that's it for that. So all I'm going to do now, quickly, I'm going to show you these, just real quick, these two problems out of the book, because I want you to understand, not the maths, but something that they're trying to show. Okay, in your book, I think it's on page 20 of the, it's on page 20 of your little text. I wanted to explain to you, it's about the forward rate agreement and pricing them. Sorry about messiness, but I just decided to do this at the very last minute. All I wanted to explain to you is that in reality, this is the same thing as put call parity. When we do a forward rate agreement, if we do anything that has to do with forwards, any pricing we do, there's an equilibrium price, the theoretical price of the thing. So in reality, even though they give you this fancy formula, all it was two formulas set equal, because they have to be in equilibrium. Remember, an equal sign is just a scale in balance. And the right side of that, equal sign was the present value of the principal and interest payment of the in-day loan at the forward rate agreement, discounted by the spot rate for maturity in H plus M days. That's the right side. The left side is just the present value of $1 in H days discounted by LOH, or the spot rate for maturity in H days. Well, it's almost like just the present value of a factor. Yeah. Discounted at the spot rate in H days. That's the two sides of this balanced equation, because the whole assumption behind this theoretical pricing, just like Black-Scholes, just like any pricing model we have, is that there has to be equilibrium. Call parity. Equilibrium.
Do you, when you write H plus M divided by 60, is that, or is that an N?
Well, if one is a 30-day instrument and one is a 90, then it would be the 120 over 360.
Oh.
Okay, because you're usually dealing with two terms. They could be the same. It's tough to add them up. All that new pricing formula is solving for the FRA in those two formulas. So anything I did to this side, I did to this side till I got FRA over here and all the rest over here. So it's just algebra and solving for one unknown. Everything else is known. And we're solving for FRA. I wanted you to understand this because the question most people are having trouble with, find these, they had this problem in the book. They gave you this new formula for the theoretical price of, so when you go to a bank or something, set up a forward rate agreement, they go through this, and they set up the price. And they put all those numbers in there. This was in a 30-day U.S. dollar LIBOR is 5.5%, and a 120-day one is 6%. And it's a 1/4. So 1 month to settlement date, 4 months to maturity. Right? And this is the price it should be. The forward rate agreement should be at 6.1385%. That's what it should be. Well, then the question went on, 9.87, said with reference to the last example, if the forward rate agreement is quoted at 6.05, is there an arbitrage opportunity? Yes. Anytime it's not in equilibrium, there's an arbitrage opportunity. So remember, you can do the maths. I'm not going to do them because they're right here. I just decided at the last minute because there's been some questions on this. Oops, that's the wrong one. That was final exam questions. You guys should have watched that one quickly. Just remember, anytime it's different from the theoretical price, there would be arbitrage opportunity. What does an efficient market say? There are no arbitrage opportunities. Now, they do exist out there, momentarily, because what happens if there is? The arbitrageurs come in and wipe it out. But if it did happen, this is how you'd set up the arbitrage. Remember, a borrower always wants what? Higher or lower rate? The lowest rate. So you would borrow for 1 month those funds at 5.5%, 1 million. The other one so the whole point of the question, even though they don't ask you, the whole point of the question is to show you why there can't be a difference from the theoretical price. Or there would be an arbitrage opportunity, and we know immediately. Now what's sad is computers do it now. You have no chance. The minute it appears, the computers go in, make that trade, and they capture the money, and it all comes back to where it should be. Everything's computer now. They are set to go off the minute they see an arbitrage opportunity. That's what an efficient market's about. Not that they don't exist, that if one happens, the arbitrators will get rid of it. Now, question 9.9, the whole purpose of that question is not the maths. I hate that they don't make the point, but in this question, they said, suppose a firm borrows, wants to borrow, I can't even read it up there, you guys can't do it, and I can. Suppose a firm wants to borrow, well, whatever. Anyhow, I'm going to get to the point. I can't even see that. Suppose a firm plans to borrow $5 million in 180 days. The loan will be taken out at whatever LIBOR is on the day the loan begins and will be repaid in one lump sum 90 days later. The firm would like to lock in the rate it pays, so it enters into a forward rate agreement with the bank. The bank agrees to lock at 12%. Determine the annualized cost of the loan for each of the following outcomes. And interest is based on 90 days and a 360-day year. So it's Australia. If the LIBOR in 180 days is 14%, is there a way to, how do you? The point here is not the math. The point here is to understand that if the LIBOR is at 14%, which is higher than the strike rate, then the winner in this case is that the firm will receive a payment from the bank. So the knowledge here is not using your calculator, is that if the rates are above the strike, the firm will receive a payment. That's the knowledge. And the other one, the rate is below. That means that in that case, the firm will make a payment. They have to pay. So the whole point to this question is not the maths involved. It's the knowledge about who's the winner, who's the loser in those events. If I was testing this, that's what I'd ask, not for you to do the maths. As you'll see in my review here now, I absolutely, totally believe, and especially at the master's level, making you do a bunch of calculations and using huge formulas only tests your ability to use a calculator. True finance knowledge is about relationships, language, understanding what something is, how you use it. That's finance knowledge. Being able to use your calculator is a skill. It's a nice skill. But it isn't anything to do with finance. So let me go on to the little review I have. Oops, don't want that one. Oh, what is this? Let me go back to the PC first. So I didn't want to spend a lot of time on it. If anybody wants to see the math done, just make an appointment with me and we'll walk through the math step by step. But to me, that isn't what's important here. It's what they were trying to tell you with that math. Okay, let's do a quick review. This is what I think you should know for the final exam. Russell asked me, was I going to put answers up? No. Because here's why. I find that if I tell you the topics, I even show you what slide number they're on, everything, then if you take the time, you've already seen it in the lecture, if you take the time to go and read it again, then you write your set of review notes and you write it down again, and then you read it the night before the exam, because no matter what I say, you're all going to cram the night before. You've seen it 5 times. Now, if you can't find the answer, not one of these questions is the answer not sitting there in black and white, then give me a call or put something in DSO. But for the most part, if you know these things, remember, I'm only one topic, well actually 2. I was only allowed 4, maybe 5 questions. I wrote 6 or 7, but there's not a whole lot of the exam based on my questions. So these are the things I think you as graduate level math, finance students should understand. Yield curves. We talk about them all the time. Yield curves, what does it mean if it's upward sloping? What does it mean if it's flat? What does it mean if it's downward sloping? You should know this. Because then if I give you a 5 or 6 yields on different, remember a yield curve is about the time to maturity and the yield on the instrument. So if I give you 5 or 6 instruments, you should be able to plot it and tell me what type of curve it is and what that tells you. You should be able to discuss that yield curve. Then you probably will have to. You should know factors that affect the yield spreads. If I have a positive spread, what direction is my yield curve? It's an upward curve. If I have a negative spread, downward, because remember, it's always the short term minus, it's always the long term minus the short term. If it's positive, it's upward sloping. It means the longer term is higher up than the short term. That's the most normal. And flat means they're the same. Doesn't matter what. If it's 90 day or 20 years, you're getting the same yield. You should be able to interpret. There's a slide specifically interprets the shape of the yield curve. I forgot to write the number on that. But it's right there, right at the beginning of that first lecture. The theories of term structure, expectations, market segmentation. You should be able to know if you believe in that theory, what does it mean? So if I said, from the point of, if you are a person who believes in the market segmentation theory, what would that say about how the term structure of interest rates function? You should know some techniques to measure interest rate exposures, the names of them. There's a specific slide on that too. The rest I have numbers on, I think. Very important to me, 2 of the very important concepts in this whole thing is duration and convexity. Duration probably more so. You need to understand what duration is and how it's used. Where does it come from? Elasticity. With what new component? Elasticity is only about sensitivity to something. Duration is elasticity with a time component, that you're receiving a flow. It's all about sensitivity to interest rate changes. It's all elasticity. And what is duration? If you look at the difference between duration and convexity, duration is linear. It's a linear relationship. Nothing's linear, just a nice approximation. If the changes are very small, it's a good approximation. if you're asked the difference between duration and convexity, draw a picture. I think I got it here. Let me go. Duration is the straight line. Convexity is the actual bond price, and anything in between is the error. That's what convexity is. That's natural convexity. So to find natural convexity, remember, if you price the bond using duration, and those formulas be there, very simple, because remember, it's just the change in the price over the price is equal to minus D because of the inverse relationship, blah, 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 blah. Very short formula. And everybody remind me, what's the duration on a zero coupon bond? Time to maturity. I don't want anybody writing on any exam or anything couldn't answer the problem because no duration was given. Boy, will you miss that question from me. So if you're asked to find price of the bond given the duration, you just solve for P in that formula, remember. That's price. Solving for one unknown. Everything else will be given. And then you price it using the old-fashioned bond pricing model. Well, the sum of the present value of the annuity plus the present value of the single sum at the end. That's the actual price of the bond using the bond pricing formula. The difference between those two is what we call natural convexity. That error is convexity. And that's why as interest rate changes become larger, convexity becomes, that curve becomes steeper, the error becomes bigger. And it is economically significant. It's a huge error. So if you have very volatile interest rates and there's big changes occurring, duration is not a good solution. Yeah. So the convexity. Convexity works in all cases. You should understand the relationship between interest rates and duration, and the way those little numbers are, 1, 59 to 60, that would mean part 1, slides 59 to 60, or part 2, slides 1 through 7. Those are where you'll find the answer. I'm not writing them out for you. I'm going to check your ability to read. You should know about immunization and duration. What does it mean to immunize, and how can duration be used to immunize? You most likely would have to do a duration calculation, but even though they've got there, I just wanted to remind you. Let's see if I have it here. Remember to go, let me see if I have it here. And the only reason I tell you to maybe learn this one rather than the one that's on the slide. This is the one you probably learned, the one that's on the slide is the one you probably learned before. But the nice thing, if you learn this one, remember, all you have to do is, if it's 5 years, pay semi-annuals, put 10 spots down, do each, write down the cash flow, find the present value of that cash flow. If you do it this way, the nice thing is, see this number right here, 920.57? That's price of the bond. Now, the way the one's done on the computer, the one that's done on the slide that they had given you before is why I stuck with it. That doesn't work if they don't do it exactly this way. But if you do that, just number it, put down the cash flow. Don't forget that last cash flow has an extra face value in it, too. Find the present value codes, add them up. That's the price of the bond. Then take that number in 3 and just multiply it by how many periods. So if it's the first payment, take it times 1. If it's the second, take it times 2. If it's the third, take it times 3, and add those up. The bond price, again, is column 3. Duration is just take that column 4 and divide it by column 3. That's your duration. Then if you want modified duration, which is the actual how much the price would change with each change in the interest rate, you just divide it by that D by 1 plus Y, the yield. That gives you that in your study was the delta P to all that stuff. How much how many dollars will the bond price change for each 1% change in interest rates? Which is slightly different than what duration is. So if you just learn that little process, all your answers fall out. The bond price falls out, the duration falls out, modified duration falls out. And there's only really 4 steps. You don't have to remember that big duration formula. Now the big duration formula is there for you. You can use it. But this is up there. I put it up on the side for you over in Raymond's reading materials or whatever. Is this. And if you just hit that down in your head, it's so simple to work these duration problems. And in the real world, this is how it's set up on a computer program. So if you have to do a duration problem, I suggest this little set of steps is easier to learn than that big formula. Because I'll tell you what, at least 30% of you will get a bracket somewhere wrong. I guarantee you. You can be the best student in this unit, and you're going to get a bracket wrong. And boy, I'd sure hate for you to lose all those points because you got a bracket wrong. So that one is one of the few calculations I would put on there because it is such an important concept. And to me, it helps you understand what duration is. It is elasticity. So it's the present value, it's the bond price. Here's the bond price with a time component. That's the only difference between this and a elasticity problem from economics. That added time component. How many periods did you have that cash flow? So it's so self-explanatory about how duration works is why I would make you work it. So you understood the inputs. And that it basically is the bond price, it's the bond price divided by the bond price with a time component. It allows for the different periods you have that cash flow. Does that make sense to you? So make sure you understand either to use the formula or how to do it step by step. And I just find a lot of this makes it easier. So when you open up that duration template, it has one problem worked for you and then it has a blank one so you can try working another one. And this was another one, and it does slightly different and I don't like it as well simply because the bond price doesn't foul out it, and I don't think it actually explains what's going on. Because the way I show it, you actually understand it's just the bond price with a time component. But either way, you're comfortable with. Again, convexity, to understand what natural convexity is. I think you should be able to do duration gap analysis. I would never make you do find the duration of the assets and liabilities, but if you were told what the duration of the asset and liabilities are, then you should be able to analyze it and discuss it. And the most important thing about duration gap analysis is its effect on net worth. So if you understand the gap And if there's a change, how does it affect net worth? What are the implications of that gap? What's it going to do to the net worth of this firm? That's the knowledge. There's not much math there. But normally, people do when you work for a firm, they'll do a best, worst, and expected scenario. So if, in the best case, interest rates did this, this is what would happen to net worth. If in the worst case, interest rates did this, this is what would happen to our net worth. We expect interest rates to do this, this is what's going to happen to our net worth. It's used for scenario analysis. So that you, as the underwriter, you give the CFO and the CEO a report on possibilities. And when you really get good at it, you actually have a probability of which of those will happen based on economic conditions. So you start putting all these things together so that the leaders of the company make decisions. But their decisions are only as good as the information you provide them. And this is a common one used. Just one of the things used, but a common one used. Should be able to know what the managing interest rate exposures or some internal methods, but I focus on external methods, which would be your swaps, futures, forwards, forward rate agreements. You should be able to discuss each and what they're used for. Wouldn't hurt you even be able to talk some pros and cons if it's there. On a swap, be able to determine if necessary conditions exist for an interest rate swap to occur. Do you remember when we talked about that? Remember the little steps I gave you? First, look at the preferred habitat. See how much interest they pay. Look at total interest now for both parties, both sides of the swap, total interest. Then you go to their comparative advantage. Do the same thing there. Look at the interest paid for both parties. When would I know? And then we could throw in commissions. We could do the split of the interest repaid different. When do I know there's a sufficient condition exists to have a swap take place? If I add the two up, the interest you save on, if I add up the interest, the preferred habitat, and I take the interest from the language here, the habitat that they have, somebody give me the word. Comparative advantage things. Just had a senior moment. So, and if it's greater than what? If the difference between the two is greater than what? 0. That's sufficient condition. It's got to be greater than 0. In the real world, you'd have to add commissions in there and everything, and it'd have to be greater than 0. But a sufficient condition, it must be greater than 0 for the swap to take place. And if you want to walk through on those 3 steps, just go through that swap example I put up on DSO. It's just about 5 or 6 slides. It says part 1, look at the preferred habitat. Part 2, look at their comparative advantage. If it's greater than 0, do the swap. So you should be able to be nice if you could do that, because that's the most important knowledge there, is when should you do one? Because in a swap, everybody should be better off. The hardest thing for people to understand is absolute advantage, because there's always usually somebody with an absolute advantage. Every problem we worked, one person had an absolute advantage over the other person. But remember, in that case, that's usually credit. Their credit's better. But they still have to pick one of the two. They can't go both ways. So if they prefer to be here, they will be better off if they do the swap than if they just went this way. So they both have to be better off. And that means that Z in that problem on the swap example is greater than 0. In credit risk management, to me, so many of the instruments involved are the same instruments we just talked about an interest rates. And if I understand, you already had a section on foreign exchange which uses the same types of instruments. So for the most part, you should be able to discuss them in general and how they're used in credit. You should understand what a credit risk model is, what the inputs are, and what the outputs are. We don't care what the model in the middle is, we just know it shakes them up. And you get some number comes out. Anytime you have a model, it's to get some number so we can compare everything. We can compare you, and you. Your score is all based on the same inputs, and the output gives you some number, so I can only pick one of you belong to, and so I put all the same stuff in for each of you, and I take this number, and that tells me which one. It's sad to say, but I mean, like in the old days, again, you knew your banker. Especially farmers. Farmers used that banker come to their house. Things were tough. Oh, okay, don't worry about it. That doesn't happen anymore. You could walk in and say, hey, listen, I need a little money for the next 6 months. Oh, okay, no problem. You're a good payer. We know you pay. That doesn't happen anymore. You're a scorer. You're a number. Credit derivatives in general, how are options used? What is a credit swap? And they're all the same, whether it's a currency swap, an interest swap, a credit swap, whatever kind of swap, you're swapping something. Some of the benefits to credit derivatives to parties involved. That was right off today's lecture. There's a slide on it, I think. And that's it. That's all I think, because this is, remember, just one topic. So I will not be here next week. Russell will with the rest. But if there's something specific on this, I'll be watching DSO, but let me say that Russell pretty much will be watching the final exam DSO. So if it's specific to the interest rate stuff, go back down to that interest rate topic. Or call me up and come see me in my office. I never get students anymore. It's sad. See you later. It's been a pleasure.
Just wondering, would you upload the answer you showed us on the PPT just now about the questions 9?
No, I won't. I just told you why I won't. I gave you the slide number the answer's on. So if you take the time to go to that slide, you've seen it in the lecture. If you go to the slide, you look at those notes that answers that question. You write it down on your final notes. You read it the night before. You've seen it 5 times. You'll know it. Okay.
So just the figures is different, pretty much on the steps and
steps are exactly the same. So any numbers just go same steps. And I'm only suggesting that rather than the way the book showed you how to do duration, that you get that duration template I gave you. It's a little easier to follow. And it just, you use that duration template. Heck, if I ask you the bond price, it's right there. I would if I was you. Then you don't forget. I would. would you? I'm not going to give it to you.
All right.
Because all I did is try to show you a process, rather than having to memorize that formula. The formula will be there. You can use the formula if you want. I just think it's easier if it's a 5-year one and it's paid semi-annually. Just put 10 down there and this, and there's only 4 columns.
Have something like 20 years or 30 years.
I wouldn't do that. In most cases, I might tell you
I got one
duration.
last question. Is this topic examine more on the theory questions or the calculation
I
questions?
just told you what that's the only thing I'll cover is what I just put on those slides. Because remember, I'm only one topic out of 10.
Yeah.
Well, I'm 2 topics out of 10, but the rest of the test will be on Russell's side of the thing. I only had 4. The most I could have is 5 questions. He didn't know how many he needed, so I wrote him 6 or 7. The stuff I gave you is the 6 or 7 things, or I guess actually about 10 things I think are most important from this topic. Because in reality, you're never going to get all the stuff you need for this topic. It's a whole course.
Yeah.
It's a whole unit. But those concepts I've given you about that relationship between interest rates and prices and duration and what it means, that's the finance knowledge. Being able to go through some big formula just means you're good at using a calculator. But the way I've set up that spreadsheet actually shows you that all duration is the price of a bond with the added, so that's elasticity, with the added component of time. So the time period matters. In elasticity, when we looked at just the sensitivity of a bond price, the time component didn't matter. It's just how sensitive it was. But once you add that time component, that those cash flows are coming in at different times, that's duration. And so by doing it in those columns, if the first column has a time period, remember that's time period 1, 2. If it's a 5-year bond and it's paid annually, there's 5 time periods. If it's a 5-year bond and they're paid semi-annually, there's 10 periods. Just write down each of the cash flows. The very last one's always going to have that 1,000 face there too. 1 plus I to the minus n. Take that amount, 1 plus I to the minus n to get the next column. Take that, and when you add that up, that's the bond price.
So formula should be provided during the exam.
There's no formula here. It's a process.
Oh,
The duration formula is there.
Oh, it's there.
And you're welcome to use that. I'm trying to show you a method that is actually what I'm having you do is the steps in that formula. I've just turned it into 4 columns. You can't make as many mistakes. There's no brackets because you're only taking a little number times 1 plus I to the minus n and adding up some things. In that formula, you have to get all those brackets in all the right places. And if you don't, you miss 1. Your answer's going to be wrong. But this way, it can't be wrong. It's just simple math. And so all I've done in that template is teach you a way of turning it into a process rather than having to use that ugly formula.
Oh,
You see what I'm saying?
okay.
So that's not going to be there. That's not a formula. It's a process. But the formula for duration will be. So if all else fails, you can use the duration formula, which is still the summation of all those cash flows, present value of all those cash flows. So it's the same thing. I've just made it look different. Does that make sense to you?
Yeah.
Because all a mathematical formula ever is a process. You start on the innermost bracket, that's step 1. You go to the next bracket, that's step 2, right? You go to the next bracket, that's step 3. And so all I've done is do that for you. And so if you learn to just take and make that little chart in your head, there's only 4 columns, remember. Time, the cash flow, the PV of the cash flow, and then the PV times the time. That's it. And all the answers at the bottom. Then to get duration, just take that column, the PV of with the time, divided by the bond price. That's duration. So it's 4 steps. Does that make sense?
Yeah.
I'm just trying to make it easier on you.
Yeah.
Because it actually...
By the way, the what we say, the process that you told us just now is not as a means during the exam, is it?
Huh?
The process you told us just now, like the time period, cash flow stuff, that won't be examined during the exam, is it? It's just like normal.
I'm just offering, yes, the duration is examinable.
Yeah, yeah.
And you can either use the formula, and all I've done is take that formula and turn it into a spreadsheet.
Oh.
So I've just shown you a way to look at it instead of having to use that ugly formula. It's the same thing. It's the exact same thing. They're equal. It's just that this one turns it into something is very simple math. This one looks uglier than heck. And what's funny, to do this one, you're going to do the same thing I showed over here. You're going to have a piece of paper and you're going to have those columns. I'm just showing you a method that actually the bond price falls out of it, everything. So you could use it to answer 2 questions. So if I asked you the bond price too, that's there too.
Would you really present all the process on the answer sheet, or would you?
No, that's up to you. I only suggest you do, because if you make a silly error, if you have that there, all right, because if you just have the formula and you just got some numbers there, the problem is I don't know where your error is. But if you got everything out, if you had that little chart there, and I see, oh, look at here, they put the present value, they say that it was the present value of 90 and you've got an answer of 109. Now, first place, you should have caught that, because the present value of anything, is it going to be more or less than the actual thing? It should be less, right? If it was future value, it should be more. So you actually, if you work the whole problem and you're running out of time, you could actually go back and say, oh my gosh, this can't be right, because that's 109 and it wasn't, and it's a present value, it should be less than 90. You could, but you got 5 minutes left. You can just circle and say, I know this is wrong, it should be less than 90. But everything else is worked right. Why would I count much off? Because you understand how it works. You just made a calculator error. So I said in finance, all you really have to know is 1 plus I to the minus n. Or for some of you who don't like minus n, 1 over 1 plus I to the n. Because those are equivalent statements too. Because remember, the minus n is just the inverse, which is always 1 over. But my whole life in finance, that's the only 2 things I remembered. I want the present value, it's 1 plus I to the minus n. If I want the future value, so I want to bring it minus. If I want the future value, it's 1 plus I to the n. So, 2 most important formulas in finance. That's all you need to remember.
I want to ask you a question about the cap strategy. How can you make a profit by using this strategy? Because
You're not trying to make profits.
Yeah, that's what I.
But you're not trying to.
Yeah, I know. So why do you want to sell the cap that you bought before and then buy a new one at a higher level? That's what I.
Well, all you're doing is following it up. All you're doing is locking in as you go up. So it's just a way.
The reason why you buy a cap is
Now,
that
cap, remember, is many
caplets.
caplets. Huh?
You want to stop paying more payments.
You want to lock in a top.
A top, yeah.
Yeah.
So if the interest rate goes up, and you don't have to pay that higher interest rate, and you still pay.
But remember, caps only last so long. So once you get here, it's just like it's like having bonds. And you invest in these bonds, and you're getting a 10% return. And then they come due. And the ones you have to reinvest in, you can't get 10% anymore, you get 2%. And you can't protect forever. You can't lock in this rate forever. No one will do it. So what you do is you're just keeping it lower than the market, a percentage lower than the market, all the way up. Because they expire.
Yeah, they expire.
Yeah. And so what you're doing is working your way up it.
Oh, so at this stage, and this one has already expired, so you buy it.
Yeah, you got to start some, but you're actually doing it ahead of time. You're anticipating it, so you're actually stepping up it anyhow, because you're expecting rates to go very fast up. Because remember, if you're a bank, you're on both sides. You're lending and you're borrowing. Remember, you're lending and borrowing both. So you still want to follow up, because you're also going to be lending up. So, but you're trying to just keep within I guess a corridor would be a best word, a corridor of interest rates. You're lending and you're borrowing.
So you continue securing your.
You're continually moving yourself up. So you're keeping that corridor all the way up. Because one's paying off the other. So you got both hands working.
Okay, because as the time goes on,
and the interest goes up, and actually your previous cap expires. So
Yeah.
that's the reason why you have to predict.
And you roll into the next one.
The shrink of the,
That's right.
the interest rate.
That's right. And it's called rolling over. You roll over into the next one. I do it with stocks a lot. I let they expire, and I just roll into the next one at a higher price. So
It's not gonna make you any money.
no. It's about it's about knowing what you're going to have in a year.
All right. And it saves
About
you-
knowing.
saves more money for you.
Well, for planning.
Yeah.
If I know what I got coming in and I know what I got going out, I can plan better, right?
Yeah.
So it does limit how much you can make. But a bank shouldn't be speculating. And making money is speculating. So what you want to do is ensure your profit, your
Well, this kind of
expected
like hedging
profit.
strategy.
It's all hedging. Everything we talked about is about protecting what you need to have to stay in operation. Because the worst thing you can do is go out on a limb. A bank shouldn't be a speculator. They should just be making the steady stream of profits. And what got a lot of the banks in trouble was they started changing from banks to speculators.
The same thing for this graph. So the gap between this point and this point is actually the money that you save. It's
That's
not
right.
The money that you get.
Yeah, it's called a gain, but it's
Yeah,
just
yeah.
it's the money you saved.
Yeah.
Yeah, and then see it ended, so the next one it's up this way, and if you'd have stayed in it, and afterwards, remember you enter right back here, so then you'd have a second one here, or otherwise it's going to head off on you. So
Well, so this cap strategy will like keep going overs and overs until.
yeah, we call them rolling them over. Most all of them are again they're options, so it's caps, floors, and collars are traded on a market. So they're actually structured instruments. And so we always call it rolling it over. I'll go and I've got some options on X stock. And option expiration's coming up this Friday or something. And my options looks like it's going to expire worthless. Well, rather than I'll go ahead and enter the next contract. It may be at a little higher level or lower depending on my feeling, or at the same price. So I just go ahead and enter here, and I'm actually in two options for a little while. Then this one expires, but the money I got from that paid for this new one. So it's just, I just keep rolling it over. Now, I tend to write options, covered options. I own the stock, and I usually buy it on stocks that aren't moving much. You know, it's one of those stocks I bought and hold, and it's in one of those, is it ever going to do anything? Like for a long time, it was my gold stocks. It's not them anymore.
You looking like?
I like gold companies. I like the actual, not the physical gold. I actually do companies. But I got one stock, and it was just, till the recent few years, it was just sitting there. I knew the company was great. It had tons of reserve. It just kept sitting there, so I just kept buying options. And so somebody thought it was going to go. I wrote options. So they paid me, and I wrote call options. So they were thinking the stock's going to go up. I'm betting it's just going to stay the same or go down. Now, I hope it didn't go down. I owned a lot of the stock. I'm just assuming it's going to stay the same. So they paid me. Stock didn't do anything. Option expires, I get to keep those premiums. And to me, then I lowered my purchase price. Then, go to the next thing, still just sitting there. So I sell another option. Like, it's just going to stay still. And I just kept taking in that money. At some point, my stock maybe takes off, and then I got to sell. They get to buy my stock at the option price. But I've gone up so high in the option price that it's what I would have sold the stock for anyhow, and I've reduced my purchase price by all those premiums I received, so I'm getting a huge profit. I don't care if they call it away. Now, I might think it's so good I go right back in and buy it. But to me, when you have stocks that are in a buy and hold strategy, and you know you're going to have to sit on it a year or two, maybe they've got some research and development. It's a drug stock, so it could take 5 years for it really to take off. And when you got one that's going to just sit there and languish for a while, and play the options market. Make a little extra money. It's not a lot of risk if it's covered. If you're naked, there's a lot of risk.
Naked doesn't mean like
you don't even
just
own the stock. You're just selling an option. But I've got this stock. So if they exercise their option, they take my stock. And I can go buy more, or I can say, that was good enough, I'm willing to take that. That was a good enough price for my stock in the first place. So that's a strategy. That's a buy and hold strategy for me. That's what I use them for. I'm tired of sitting here. I'm making nothing on this stock. I might as well be making something. So it's a way of me keeping my stock and still making money on it and lowering, to me, in my mind, I'm lowering my purchase price.
But by the way, you think the gold price will keep going up? Like now it's 1,500 per ounce, yeah?
I don't see anything stopping it.
You see it's bubble.
Only because you've got two huge markets that gold is very important to.
India and China.
That's right. I mean physical gold.
Yeah.
There's not enough gold to even meet the appetite of India for 1 month. If they all started buying what their appetite is,
Yeah.
the gold reserves would be wiped out. Second thing is that everybody's so concerned about European, United States.
The Europe,
Their currencies and stuff. People want gold. And again, they can't get it out of the ground fast enough to, just think if China, if every person in China just bought one little
1 ounce.
1 ounce, there's not enough gold.
So you
But
think
that
it will
is the
keep going
goal.
up for a while, right?
Yeah, I just don't
It's
see.
retreated for the past
It could
weeks, I
retreat
think,
and it could
yeah.
sit here and bounce. If you start seeing it doing a whole lot of bouncing where it's hit a barrier,
Yeah.
but what I've noticed so far, every time we think there's a barrier,
Yeah.
it's pushing right through it again. I would have never thought we got to 1,500.
1,500.
Yeah, I'd have never thought. I remember when
Yeah.
I went into all these gold stocks when gold was at 300 and something. Was astounded when it went to 500 and 700. So I'm just astounded at the prices. And my gold stocks have doing nothing different, just the value of the reserves. It's crazy what some of these stocks are doing. I bought one for $2 and it's selling for $12, and I haven't owned it that long. And I've got another one that I owned the stock and I bought it at $5. It went to $50, and they sold the company at $50, but they spun off a part of the stock to us stockholders, and that stock now is up to 12 or 13. So I'm, but I never ever thought gold's go where it's at, and you don't make as much in the gold stocks as you do gold itself. But to me, it's safer because then I can look at gold can be like a currency, quite volatile too. And I don't want to take delivery of a bunch of ounces of gold. Somebody will rob me. So I buy gold companies, and I look for a nice.
Do you want to tell us which gold company you're after?
Well, I'm not allowed to actually.
No, just like private, like.
No, I'm not allowed to. And everything I buy is in the U.S. market. I have never entered the Australian market simply because they're too small. It's much too volatile a market, and I think they lack all control here. I think there's a lot of insider trading goes on here. And
Oh, really?
I don't trust this market.
Australia is even better than the United States.
No.
No?
No, they get caught in the United States. I put the paper up for you guys about this internet. I caught them insider trading in this country. And when I sent it to the Securities Commission here, they actually came after me. Where did I get the data from? They were upset with me, and what they did then is change the way they record these trades.
How did you find like they did some insider trading?
Because I caught them.
From their financial statement?
No, from the trades. Because in the old, up to a couple of years ago, when a trade was made, the code for the company that made the trade would say like MERL. No, it's Merrill Lynch, right? Or it'd have their initials. And so I actually caught. The news came out after the market closed in New Zealand. It was a huge company in New Zealand, but it trades heavily in Australia. And I knew it was going to happen. The federal government over there issued something after the market closed. Problem is, this market's open for 2 hours after the market closed.
Yeah.
The trades began in this country 30 minutes before the news came out. I got a message that the big brokerage houses got the news 30 minutes before. And I have documentation of all this. What I had is an insider capturing it for me. And all Australia was worried about is, how did I get that data? Not that there was insider trading went on here in Australia, big time. Everybody in New Zealand lost their money. They lost 30% overnight. They had no chance. And only the big houses here made any money. It's the most trades ever in this company. Never had there been volume like that 30 minutes before the news. And I documented it all, and they came after me, that I shouldn't have had access. And what they did the very next week, the House here, the Trading Commission here, changed those codes to numerical codes now. They aren't MERL or